Welcome to the Family Banking Show with your hosts Rob, Derek, and John, where we dive into the world of the infinite banking concept and discuss personal banking strategies to secure your legacy and build generational wealth. We're glad you're here, and we hope this episode serves you well.
All right, welcome back, ladies and gentlemen, to the Family Banking Show. We're your hosts, Derek, Rob, and John. Guys, how's it going this week?
It's going well. I just got back from Nashville, Tennessee.
Right.
They love their barbecue, their hot chicken, and it was a great time. I got to see Broadway, their main kind of strip downtown.
Mm-hmm.
I mean, it was a Wednesday night that I saw it, and it was packed. And I'm just thinking, what do these people do? You know, like, maybe it's just that many people on vacation, but it was a good time. And
A lot of country music, I assume.
yep, all live country music.
Mm-hmm.
Nice.
Did you guys pop into any places, listen to any music?
No, we just drove through. We had an early morning the next morning, but it was good to see everything.
Yep, my sister lives in that area, so we get down to Broadway every once in a while. If you'd have told me you were going to be there on a Wednesday night, I would have told you to go into AJ's on Broadway, because all they play if it's not 90s country, we don't play it. They're like, if you want to hear new country, go down the hill, is what they say. It's a fun spot.
Yeah, it is.
Well, good. Well, glad to have you back, John. Guys, this week we're talking about page 41 of Nelson Nash's book, Becoming Your Own Banker. And as we've discussed in the previous episodes of this podcast, we've gone through part 1 and part 2 of the book. Now we're on to part 3, which gets into a little bit more of the strategy. Today, we're going to hone in on the different methods that Nelson describes as to how people pay for the things that they need in life. The example that he's following in the book is regarding financing a vehicle. And in today's episode, what we've tried to do is use modern examples, current rates, to give you an idea as to how the infinite banking concept could be practiced in your own life. John, why don't you go ahead and describe just at the outset what the different methods are that Nelson illustrates here?
Of course. So Nelson, I think it's genius that Nelson includes this, because everyone at some point or another, unless you are a New York City resident and you just walk everywhere for your entire life, you're most likely going to have the problem of having to finance a car or save up and purchase cash. So Nelson describes 5 methods, right? He describes the leasing method, which he very plainly says, pure logic, it shows that that's the least efficient. You're going to lose money on that. So that's method A. Method B is the bank method. Very, very common. You get a car loan, use that to purchase a car, and you pay it back over time. You kind of incur that debt from the outset. Method C is the cash method, and that's what everyone will associate with Dave Ramsey, saving up over time, probably getting a less expensive car, so that you can afford and not have to get any sort of debt associated with your car. And then methods D and E are really interesting. Method D is, instead of saving up your cash method, right, like Dave Ramsey would say, you end up saving that and purchase a CD, a certificate of deposit. That in this chapter, he assumes a pretty high yield on these CDs. He assumes a 5.5%, which we're already seeing is very high in our current time, and over the last 20, 30 years is pretty high. But point is, you purchase that CD, you have it earn the interest, and from it you withdraw to purchase your cars. And I like how he keeps kind of the same assumptions, that the car, it costs $10,550, which we'll have our own assumptions when we get to our examples of present day examples, and so forth. So the CD he shows is slightly better than the cash, slightly better than the bank. And then obviously he'll go to the IBC method, using a dividend paying whole life insurance, cash value to finance the things of life, particularly a car in this scenario. and just all the benefits that it provides, all the growth that it'll provide, that you're not interrupting. And we'll get into that in a present day example as well.
Well, let's go ahead. Let's jump right in. Rob, you had pulled up a software tool that you've been using called Truth Concepts. Why don't you go ahead and explain that just briefly and then provide us with that first example?
All right, so what I'm going to show you guys. Oh, and for the podcast listeners, we are now doing a screen share. So if you want to see what we're talking about, please make your way over to the Family Banking Show in YouTube, and so you can see what we're sharing. But what I'm sharing here is I took some screenshots of the different scenarios, and what you're seeing on the screen is a financial calculator by Todd Langford and his company Truth Concepts. And what these are a suite of financial calculators that are really powerful because they show you the impact of compounding interest over time and the effect of taxes over time. And they're really good at showing you opportunity cost over time. And so that's this calculator we're using here is called the borrowing strategy calculator, and it allows you to plug in different inputs to illustrate different use cases. So we're gonna illustrate the savings plus cash. We're gonna illustrate the savings plus loan. We're gonna illustrate the CD, and we're gonna illustrate the life insurance method. So this very first one that we have on the screen here is saving plus paying cash. And so on the upper left corner, you see that we have a $10,000 per year payment. We're putting into a savings account that's getting us 1.5%, and we are in the 22% tax bracket. And this negative 100 here means we are not paying it back. So we are basically doing the method of saving up the money, buying the car, depleting the cash, saving up the money, buying a car, depleting the cash, doing that every 4 years for 6 times, and we're paying it back over 4 years for a total of 30 years. And if we are a Dave Ramsey method process, you might say, where you're paying cash, saving cash, paying it off, you will have over 30 years. If you look in the lower left right corner, you'll have $104,370 left over 30 years. You got yourself 6 cars, you haven't paid any interest, but you have $104,370 left. Do you guys want to talk to this slide at all?
I think we should talk about the assumptions that we're making. So the 1.5%, I know you touched on that, Rob, I think we're being very generous with that, but we do want to be fair to these other methods that we're comparing to IBC. And I think overall, even stepping back, we are not comparing IBC to investments. We're not comparing it to the stock market or anything. So this is truly a savings vehicle that we're using to finance the things of life in a similar way that, Dave Ramsey method of paying cash and so forth. So in this scenario, I think just emphasizing that we're being, generous with the comparison of a 1.5%, yield on a standard savings account, which I know mine right now is giving like 0.25, but maybe it changes over time. So we're being very generous with that.
Yeah, just a couple other comments there. Savings rates that you would earn from a bank, either in your savings account, a checking account, money market, or CD, or even a high yield savings account, they never stay flat. Even the earnings of a life insurance company doesn't stay flat. It changes over time. This tool here, though, is illustrating as if those rates stayed stagnant for the entire 30 years, which we know is not the case, but we're trying to just drive a point home that depending on where you chose to save your dollars, you're going to be better off or worse off when you compare these other options here. Same with the tax bracket, right? Taxes change over time, your income changes, and so therefore you may be pushed into a different tax bracket. The important thing here is just to see that as you were saving inside a savings account and paying cash, what you were left with is really not a great turnout compared to some of the other alternatives that we'll see here coming up.
Yeah, I'd say the main probably thing there is the moment you take that $35,000 out of your savings account, you just broke the compounding. So every time you do that, you're breaking the compounding and you're starting over again. And so that's why there's and you're not paying it back. And so that's why there's such a low net result after 30 years. Okay, we'll move on to the next one. So this is a savings account But now you're going to the bank and you're getting an 8% loan and you're paying it back at 8%, you're paying back this 8% loan. Your savings account's still 1.5%, the tax bracket's the same, but the only difference is this time is you are taking out a bank loan. You'll notice you have $361,000 after 30 years because you are forced to pay it back with interest. But the interest is going to the bank in this scenario, but you still are coming out quite a bit ahead because you paid off that loan you took out. Anything you guys want to add to this one?
Yeah, this one here, we're seeing the power initially of allowing your dollars to compound, even though, they're compounding in a savings account. This is the benefit really of actually allowing that compounding to continue over a long period of time. Quite the change from the first example there of just paying cash and depleting the account.
The only thing I'll add on this one is that it does require additional out-of-pocket outlay compared to the first example, where you're paying back that loan, which most Americans, when they budget, it's just so standard to have your car payment in there, right? You have a car payment section, you have a mortgage section, you have a savings section in your budget, which maybe in a later episode we'll talk about, maybe philosophy behind budgeting and stuff like that. But this is different in that more out-of-pocket outlays is occurring on top of the 10,000 that we're saving per year. But yes, the power of the compounding here is really starting to show, compared to the first example.
Okay, move on to the next one. This is now the CD method. And this is where you are putting your money into a CD and it's being, maybe it's a 4-year CD, and then you're cashing enough out to pay for your car. But this time you're paying it all back and you're paying it back with interest. So this would be kind of this doing the infinite banking concept process, but doing it around the CD product, because Nelson says the infinite banking concept is not a product, it's a process. You can use infinite banking around any products, but he argues, and we agree, that whole life contracts are the most efficient product to do the infinite banking process around. And so just by being an honest banker, but using CDs, you'll see they have $511,000 after 30 years. So that's a big jump from the previous two methods. And that's just being an honest banker, but using the CD as a product. Any comments, guys?
Yeah, I love that the idea behind this was, like you said, Rob, to demonstrate that infinite banking is a mindset or a lifestyle or a concept and process that could utilize multiple different tools like a CD or a savings account. Of course, we're going to look at another option here in the short term. Yeah, John, what are your thoughts here if somebody were to save their cash inside a CD, but instead of liquidating part of their CD, they would instead use a bank loan to finance their vehicles? Do you think they would be better off than this picture here or worse off?
I think they'd be much better off. The main reason that is true is because you wouldn't be interrupting that compounding. And, it immediately made me think of the idea of the penny doubling every day for 30 days. Mm-hmm. Would you rather have that versus just $1 million today? And with the penny doubling every day, after 30 days, I think you get around 2.7 million, right? But the thing is, I like to call it like an access tax. Like you have to let that continue to compound. Otherwise, you're just going to get pennies probably, or something far, far less than even close to $1 million. Like even if you take it out day 27, you're losing out on millions of dollars, So that is the power, especially in this long-term approach that we're taking with a 30-year outlook. That's the power of letting it compound over a significant part of your life. And we think generationally, right? So we're thinking like, having kids policies, like letting that thing just compound over time, 30, 40, 50, 60 years, it's really going to get powerful. And so in this scenario with CDs, yes, absolutely. You'll be further ahead If you let that CD maybe compound, you roll it over into new CDs and not take out any of the earnings, and get bank loans in parallel. One thing I'll say as well, if you continue to let the earnings compound, then you're also compounding your taxes. And we'll get to that in the next example with IBC.
Okay. Thanks, John. All right, so we'll move to the last example. And this is now taking out a policy loan from your life insurance policy against your cash value of your life insurance policy. And you'll notice the tax bracket now, and I think that's the secret sauce here. The tax bracket is 0 because you do not get taxed on with the cash value that you're taking out, or you're not getting taxed on the growth. But you do have a cost. You know, the insurance company charges you interest, so there is a cost there. But over time, due to the efficiency of the life insurance product and taking policy loans out against it, you come out ahead versus the CD method. So you got 587, 376. You guys have anything to add to this?
Yeah, what I like about this method here is it obviously demonstrates the different roles that people play in the play. So Nelson goes on and describes when you're thinking about banking and taking out loans, there's multiple different players that are participating. You have a depositor in the bank, you have a borrower, you have the banker. And so here we're depositing our dollars as premium to the life insurance company that we are part owner of, and those dollars continue to grow and compound over time uninterrupted. But we're also the borrower. We're taking the loan from the insurance company and we are paying it back. That's where we're being that honest banker. So this is the method when done well and done over a long period of time, this is the one that's going to win out over all other alternatives in today's current market. As Nelson has said, and you'll hear us say, utilizing a whole life insurance contract is just the tool to achieve becoming your own banker. It just happens to be the best tool today in order to do this. And the reason for that largely is because of the preferred tax treatment and the uninterrupted growth that the policy is earning.
And I mean, let's talk about some other benefits that we get with the IBC method. When we talk about your dollar being efficient, doing multiple jobs, all along the way, you have a death benefit to protect your family, to, designate your beneficiary, be it a church, be it an organization, a charitable organization, or your family. Even if you're single, you're having that death benefit all along the way to protect you and your family. Another thing is with the CD method, if say you were to get disabled, would that CD continue to fund itself with $10,000? No, it wouldn't. In IBC method, if you qualify in a health rating, you can get a waiver of premium for disability. You can have that policy fund itself, even if you're totally disabled. And then you think long term, you could do sort of a long-term care in the later years of your life and have that solved for. So that this IBC method certainly controls the banking function. And I mean, if you think about it compared to the cash scenario one, you start with 100,000 that you're left with after 30 years. And here we're talking about 587,000 plus a death benefit, plus all the other, benefits that we're talking about. So getting the banking function down and solving for the, financing the things of life can make a huge difference. And a little bit of study, a little bit of patience on the front end can make this huge difference in your life. And then you establish this family bank for many generations to come. So these policies only get better with time and only get better with each generation that you're able to control that banking function and feel free, from you have control over the terms of repayment too. So you don't feel enslaved to payments every month and not even seeing the equity that you're building in these payments. You get access to what you pay back in the IBC method. So there are just so many benefits to this. But I think the main thing we're trying to talk about is just controlling the banking function puts you out ahead.
I'll put up the last slide that just shows the kind of summary. And so just if you look at the three methods, you got the saving plus paying cash, you come out with 104,000, 1% savings plus a bank loan, big jump because you're paying that back. Plus you're using the bank's money, 361. The CD method, you a much bigger jump because you're getting a better rate of return, but you're being an honest banker and you're paying the interest back in at a rate, filling up your CD with the higher payback rate. And then you have the best method, the life insurance, because you have the uninterrupted compounding plus the tax advantages. And then you'll see in this right column, what I call the death benefit. Basically what I did is I took the cash value and I took your tax bracket. So 78% of this is 81,000, 78% of this is 2,200. So this is how I generated the death benefit for these first three methods. And then the last method, that's from the life insurance, the illustration projection. So huge death benefit. So it's, clearly a superior process using a superior product.
Yeah, and the question for our listeners would be is, how much better do you want to be than everybody else? This is an opportunity for our listeners to say, okay, if I can just tweak one thing and I come out ahead, or I come out even just marginally better than what I was doing previously, why would you not want to take on that opportunity and to reap those rewards? And so all we've done is just said, you're saving money. You should be. Otherwise, you're using all loans and you're really always staying in debt and never really being able to build wealth after that. But where are you saving those dollars? If you're saving it in your savings account, you're not going to come out better ahead than an IBC method with life insurance. And same goes with the CD, as we've already looked at. Even as rates change over time, the performance of a whole life insurance contract has always exceeded the performance of those CD rates and either money market accounts or just your traditional savings account. So even if you think it's just marginally better, why would you not want that for you and for your family? And then you tack on that it's got, a much, much larger tax-free death benefit to help your heirs and your beneficiaries out when that time comes. What a great way to bless them and their future.
This is just truth. This is just facts. We're not throwing opinion or emotion into this equation. And anytime you're presented with truth, I think this is just a general truth, way of life, is that if you're presented with truth, you have to do something about it, right? In a faith sense, I was presented with truth. Like I had to decide what I thought about it, right? So we're hoping to just spread this message of truth and how to control the banking function and just encourage people to make a decision about it. And, to me, it's an obvious decision, obviously, because I do it and I preach it and I love it. I think we're all called to just, be good stewards and be efficient with what we have. No matter if you have 10 million or 10,000, right? We're showing this with 10,000 every year. You can make the most of what you have, no matter what it is. So it's, to me, a no-brainer, especially when seeing the comparison and the guarantees also is huge. Derek alluded to these CD rates do change over time. And I think in 2020, the CD rate was around like 1.5%, maybe even less than 1%. So there's no guarantees in there. There's no guarantees other than in the IBC method compared to everything else.
All right, guys. Well, thank you so much for your input. And Rob, thank you very much for putting in the legwork on using the Truth Concepts tool. We hope that was a valuable insight for our listeners. In the next episode, we're going to be looking at how Nelson says that we should be expanding our life insurance system, our IBC system, to accommodate all income. And I know that's a hot topic and something that I hope our listeners will enjoy. Guys, I think we'll see you in the next episode.
Right. Thanks.
Thanks.
Thank you for joining us. If you're interested in a conversation about anything we've discussed, you can find our contact information in the show notes below.
And subscribe, follow, and leave a review to help spread this message and to help families across the country discover the generational blessing of IBC. May God bless you, and we'll see you next time.